Good morning and welcome to Nifty prediction. This video is for education purpose only. After a long time, I'm once again coming back, and this is the Monday prediction. The ratio indicated 4:3, which is on the positive side, but the difference of 1 point, which indicating that the market may having chances to fall after some certain high if it is matching with the data. And likewise, the same around average is also showing 2:1 on the positive side. The difference of 1 points. The basic rule is that if the market is keeping the high matching with the data, it may fall down. And the weightage is clearly indicating positive 4.07 versus 1.82, and absolute frequency 1:1. I took a gap of almost a 1 month time period due to I have did some other small changes in the data as well as that is not huge, but I want to uh, make the investors or maybe traders to understand the prediction and how to play with it using this method. It is very simple. There are some key points which you need to understand. So this video or maybe in the future videos, it may be take some 25 to 30 minutes time period so that you may have a clear understanding about the formulas and how to trade with this. So if anyone know about the CPR, they will easily understand much more. So I would like to add on that CPR as well. This is the CPR which included in this. uh, I will show you the difference as well. The CPR which comes in the green color, CPR R1, R2, R3, R4. This is Monday, the same data, and this is the CPR pivot. And so whoever don't know about CPR, go to YouTube and search about it, so you will understand what kind of a method they are doing. So I will also explain how to trade with our data and the with the CPR. So normally what happens is in this there are certain basic rules which we need to follow. I will show you that. So this is the indication. So first we need to watch out is that the four indications, how it is indicating. Normally if the data are showing one side, for example, if all indications are in the positive, which means it is a positive day, so 80% chances of ended up in the positive, 20% chances of ended up in the negative. So which means normally 80-20 principle applies in every data. So if all four indications showing one side, means there is a good amount of chances that the market having go towards to positive. So that if you have this data, you can buy a call option or you can buy future with this. So it has a chances of ending up in the positive around 80%. So you have the freedom to take a position well in advance if you have my prediction data. On the other hand, if all four indications are showing positive, but 20% chances might have go in the negative due to the pre-open is not supporting. For example, the data is showing all in the positive. Here it is mixed, so I'll come back to the tomorrow's prediction. I'm telling about all four indications are in the positive. So if all four indications are in the positive, means you have the flexibility to take position in advance in the call option or buying the future. If the pre-open is in the negative, which means you need to exit on the same level in the market, because the bullish is not supported by the pre-opening. So that is the indication that the market may have the chance to go other way around 20%, even though it is showing that it has a chance 80% of bullish, but the pre-open is in the negative even 10 points or maybe even 1 point in the negative. That is indications that it has a chances of going towards negative. It may go even 100 points in the negative or maybe 200 points negative, we may not know, but it is not supporting the 4 indication show. So you need to avoid going or holding the position in the call option or in the future. So that is the method. uh, but mostly it has a chances of opening in the positive, means it might go in the bullish, and these are all the basic rules which we need to follow. Normally, if 4 indications are showing in the positive, the basic rule, if that the market pre-open is within 30 points range, then that is an one advantage which you have, that you can hold for long position, but with the condition of previous closing stop loss of 10 points. For example, if Monday, I will take this. Monday we have the data in the mix, but let's take all the data are in the positive like that. So if the pre-open is above positive and within the range of 30 points, somewhere within the range of 30 points is the pre-open, somewhere in between, if market is opens 15 points in the positive. The condition what it has given, the basic rule condition, it is applied to all days. uh, 10 points stop loss, so we have to keep 10 points from the previous closing, which means if we take the around 10 points minus 10 points of stop loss, it will be 10,006. I mean 10,168. That is the stop loss level we need to maintain, because 10 point stop loss. So here this particular 10, this particular 11,168.40 is not breaking, then it has a good chance to go extremely big bullish, because 4 indications are showing in the positive. But here on Monday we don't have 4 indications or showing in the positive, but still it is applied to any data, any, no matter how, what kind of data we are having here, but still the basic rule can be applied to any day. So you need to keep it in this particular logic in mind. Anywhere in between the pre-open is opening 0 to 30 in the positive side, previous closing stop loss of 10 points, if the market is not breaking, it has a potential to go extremely bullish. You can check any day if anything, because the past record history, you can go and check it out. You have the good amount of bullish trading days happened in this particular range of levels. So if anything opens less than 30 points in the positive and not breaking the previous close of the stop loss of 10 points, it has a high chances to go bullish even on Monday as well, because it is a common rule. Likewise, the same in the negative side. It is for all the days. If anything opens less than 0 to minus 30 points in between in the negative, the same kind of rule will applicable on the downside as well. So what we have to do is the same rule we can apply with the stop loss of 10 points on the positive. So we need to add 10 points. So the stop loss must be 11,188. You need to keep and go for the sell. If the market's pre-open is in the negative, around 0 to minus 30 points in between. So if that particular level is not breaking, means it has a good chance to go extremely bearish. So I'll tell you, this is the level, and if the market is opens 30 points, I mean 30 points negative from 0. So if 0 to 30 points, if the market is opens pre-open and stop loss, means it has a chances to go extremely bearish. It may go to any extent. So that is what the basic rule is. And the other basic rules If the high or low is perfectly matching, then we have the good chance to go according to the matching. For example, if high is matching, the level is somewhere 10,300. I'm just taking as a example. So the stop loss level is 10,310. So adding 10 points, and anything in between keeping the points from 10,000 to 97 to 10,310, which is perfectly matching. So which is that the perfectly matching is nothing but it has to be within the stop loss range or 3-point range. So if we take it out 3 point from this, it gives 10,297. So which is high is matching, then you can go for a sell keeping that level. So likewise the same on the low is matching, the same level we can take, but we need to keep stop loss on the lower side 10 points, and we need to keep 3 points, because anything having difference uh, above or below the 3 points or more than 3 points. For example, here the stop loss which comes 10,290, and if anything breaks that 1 point, for example 10,289, 1 point difference from the stop loss, which is indicating the market will go towards to the next level on the downside. Likewise, if the market is not reaching towards to the 10,303, which is about 10,304, means it is not matching. So which means it is above 4 points and not matching inside those levels. So I'll explain the same with here. For example, the test level is 11,300 range. So the stop loss, if we go for a sell, the stop loss will be added 10 points, right? So I will take here plus 10 points. So which is 11,310.24 is the stop loss. So if the market is keeping inside 11,300 to 11,310, which is perfectly matching, so we can keep this level, I mean this level as a stop loss and go for a sell straight away. But the market is inside 3 points, which is 11,297. So if the market is reaching 11,297.25, then with which is, if you take these two levels, the difference of the point is less than 3. So anything comes less than 3, which is also perfectly matched. But if the market is somewhere keeping the high some 11,296, which is more than 3 points, almost 4 points, so which means it's not matching. So that is indicating that the market may having chances to break this level. The market is having chances to break this level and go higher range, because it is not perfect. If the perfection is there, then the market will having chances to fall down. For example, I'll show you that the Friday market data. Friday in my data, which is I didn't upload it, but I have took the data and I have sent to my group as well. This is the level which is matching average of 11,111. If you check the Nifty low, it is perfectly matched in that. You can go and check the uh, low on the Nifty on Friday. Likewise the same for the high. If you take the R1 to test level, which is matching 11,367, even we have three R1 all put together. If you take, which is 11,369, and if you go and check it out, 11,366 point something is the high, which is having difference of 3 points. So we will get only one resistance levels, but here we have three resistance level one, which means it has a good chance to uh, keep somewhere in the low. So 11,367, 1 point only the difference. So that is the reason it has kept that particular level as a high. And one more interesting fact is that if we take the average, which is also matching, see the average of particular positive average and the high chances to fall and the low chances to fall. So all the numbers, sorry, on the previous closing level average, which gives the exact number, and the lower side also it is giving exact number from the negative average and the low chances of recover and the previous closing. So both giving exact points, and the closing also it is giving exactly with the average of these two. The market has closed in the range of 11,180, but Friday it has closed 11,178. So how come these averages all comes with a matching? See, I took this average from the level of 2 to bullish open target level. That is where the average comes. And likewise the same, I took the average here from the level of 2 to the bearish open target level. All put together it gives perfectly matching high and low and closing. The high is matched with the average. This average is nothing but, this particular center average is nothing but the average of high and low. The high and low, G16 is nothing but the high, and G40 is nothing but the low, which is those levels I'm tracking. So if we all put together take the average, it perfectly gives the clear picture how the market has closed on Friday. From the positive average I took this, and I took the high, and I took the average. All put together average gives the exact high, 11,366. That is what the high on Friday. And the low, if we take the negative average and the low and the average put together, it gives 11,129. But on that particular day the low is 11,111. The difference of 18 points it's there, but still it is matching with the average here. And if these two average if we take, that is what the closing 11,180, the market has closed in the range of 11,178. So if we take the same method on Monday, we'll come to the market closing and other details how to check. So this is the average from the level 2 to bullish, that is the gap up too much level, and the gap down level which is 11,190. If I take the positive average level from it, from the average and the previous closing average, it gives 11,390. So on Monday this particular level 11,397, we need to watch out, because if anything is not breaking this particular level, the market will fall down. But it is having huge points, almost 220, close to 220 points it is showing. So we need to be careful on Monday, because it has a chance to go towards to that particular level. It is showing, but we may not too sure about how it is going to be. But we have a chances here that when the absolute frequency is 1 is to 1, the here is the rule says 33% chances of closing all side, bullish, bearish, flat. So we need to play much more cautiously. It is quite difficult to understand initially, so that is the reason I am explaining briefly. So if you follow these rules and steps, you have a good chance to go good number of profit on the particular trading session. So here is the chances that how it might have gone or go towards the negative side. 11,087. So what this is indicating, that the low is having chances and high is having 11,397, low around 11,087. These are the chances. But here, how to play with this data? Whenever 1 is to 1 comes, it is the clear indication that small traders must have to avoid this particular trading day. It is not going to be that much easy. Risky traders, they can trade with a particular amount of risk appetite range, how much you can tolerate, that amount of money you can park in the option, or maybe even in the future as well, because it is a quite risky day. But it is worth, if you know the trend, or maybe if you know which side the market is going to go, then you can bet, because it will give enough number of profit, enough amount of profit. Because if you don't know, better avoid this particular trading day. But here what it shows, as per the summary, once the high is matching, the market having chances to fall. So two times it is indicating. So if it is opens in the positive, but still, if the high is not matching, it may go towards to positive side up to 11,000, 11,000, almost 400, 397. That is what the range, and the bullish open target level is there up to 11,380. If we take 10 points stop loss, it is matching with 11,390. So up to that level is there. So that is the reason we must not to take risk. On the other hand, the other data which indicates bullish, which is what clearly shows, but this one indication is uh, giving an hint it might go negative as well, if the pre-open and other parameters are matching. So it might go bearish too. What are those points? The first point is, if the pre-open is within the range of 30 points to 0, we already saw that. Or the second point, which is that anything breaks the bearish open target level, it might go towards to the extremely bearish. So once the bearish open target level, if it is breaking, which is around 62 points, so if we add 10, I mean if we subtract 10 points to 72.60, if anything breaks. So if I subtract 10 points, 11,105.80 is breaking, then the market may having chances to go extremely bearish towards to the next level, which is negative average 11,000 not 77. So that is where this particular level is aligning. So 870.04, that up to that level. If anything breaks further 10 points from that stop loss, which is if further 10 points from that particular level, it gives minus 10 points, 11,067.75. If it is breaking, then money it will go to next level, which is, it might be the average of 11,026, or it might be 10,974. These two levels it has a chance. So these levels are we need to watch out. So uh, the basic rules, one particular rule which I told is the pre-open within the range of 30. The next set of rule is that the volatile level 1 and the volatile level 2. These two levels will give you an indication. Anything opens in between these two levels, you need to avoid trading, because it is going to be tough to trade, and it is not going to be that much easy. But if anything opens above or below, then you can go with the trade. For example, if anything opens above this particular volatile level 11,228.70 above, if the pre-open is opening, you keep stop loss in the overall average stop loss 11,000 minus 10 points. This is the level you need to keep stop loss. So that is the level which the first rule for the bullish. Pre-opening is above 11,228.70. Then you need to keep stop loss 11,182.55, 11,180.55. So this is the stop loss level. You need to keep, anything opens above this level, then the market is indicating bullish, with a stop loss of this particular level minus 10 points. So any level we need to keep 10 points as a stop loss. So this is the stop loss you need to keep and go for a buy. On the other hand, the same data is applicable to all kind of levels. If anything opens below 11,160.51, below that level, if the pre-open is opening, then you need to keep stop loss in the same level, adding 10 points. So adding 10 points, so which means it will be somewhere 202 point. I'll tell you, instead of subtracting, you need to add. So it will be 11,000. It will be 11,202.5. So these are all the other steps. So if this method you can apply to any day, because if that particular level is not breaking, for example, the market is opened below this level, the pre-open is showing, because 9 the pre-open will close at 9 not 8. So that time you will come to know what is the pre-open. At 9:08 a.m. you will come to know the pre-open. So what happens is that if the pre-open is below this level 11,160.50, so anything below this level, so that is an indication that you need to keep stop loss in this particular range. It might go bullish also, but all we need to watch out is that this is the method for the bearish. If this particular level not breaking with the stop loss, which is adding 10 points, so you will keep this stop loss. If this stop loss level is not breaking, then the market will go extremely bearish. This is the rule for the bearish. So if these rules, if we follow, then definitely you can make money. On the other hand, if the matching high and low, there is then another step. For example, the market is opens anywhere, it might be open anywhere. The level which we need to watch out, the high is matching or low is matching. For example, if the market is open somewhere in the positive 40 50 points or maybe 60 points, which is 60 point, if it is opens, then it is above this particular volatile level, so we know that it is a bullish day. But it might go bearish too on this specific day, because we have the levels which shows that it might have a possibility that the range which is having difference of 1 point, so after keeping high, the rule says that after keeping high it may fall down, because after keeping high it may fall down, that is what the rule says. So we can go for a sell if the high is matching. So this particular point you need to must have to keep it in mind. If the low is matching, it is a buy. If the high is matching, it is a sell. So all we need to watch out is that whether it is matching in the average, because if the points are very high, then we need to keep the average matching or not, because gap between the points almost 70, so which means it might have keep this particular level as a high. So the stop loss from this particular level, which is 11,274, so in between the market is keeping the high, then it is a matching. So on the other hand, if the particular level, for example, if we keep the stop loss of 10 points, so it will come 11,264 plus 10 points, right? So 11,267, so the decimal is what it shows 47, so we can take 0.5. So 11,274.5 we need to keep stop loss. So anything above 11,274.5, so anything about 11,274.5, which is, if the market is breaking that particular level, then it is indicating that it will go to reach 11,300. That is what the breaking level point. But yeah, that is how we need to trade. So if this particular level is not breaking, then the market will fall. If it is breaking, then the market will go to the next level. But if it is not matching on the high, definitely it will match on the low, because then only it will go to the next level. So you can check out the high and low if it is matching. For example, if the level is matching, so I'll 11,264, so those 11,000, so I'll take the average here. Average of these two, so which is 11,264.74 plus 10 points. I'll take 10 points, so 11,274 is the level. So if the particular level is not breaking, the market will having chances to fall, because it is shows that matching. So I'll take the high somewhere in between 11,000 to 61.5 to 11,000 to 74.47. So this is the level, because 3 points from the average, and this is the level. So if we take the round off, so we can go for a 10. So if we take out the stop loss, which gives 11,204, normally we need to keep 3 points, so which gives 11,161. That is the reason I have kept a round off of 11,261. So if the high is matching, means it has to align in these ranges, because of inside the stop loss and within the range of 3 points. So within the range of 3 points, which is perfect match. Inside the stop loss is always a stop loss, because that is how the market is works. So if that level is not breaking, the market will fall down from this particular level downside. But the key is whether it is going to fall furthermore. This overall average must have to break, because we know that we already saw that rule. Anything opens above volatile level, the overall average is not breaking, the market is bullish. So this particular level is breaking, then it is indicating the market will go down. But we need to keep the levels where we need to book the profit. So that is the good chance, we if we know the CPR, because as per the CPR rule, the CPR rule, you can go and check it out in the Google, and you will find in the website as well, like trading view and other, you have the CPR levels. So what the CPR is indicating, whenever it is opens above our CPR R1, which is indicating that the market having chances to go CPR R2. Likewise, if the market is opens in between the CPR range, which is around 20 to 60, which is the no trade zone, around 60 point to 20 points trading means it is called no trade zone. But in our data, we can trade with the stop loss, with the levels. But as per the CPR rule, I'm telling. So what happens is, if the market is not reaching this CPR level, which is indication that the market having chances to come down CPR, if it is breaking that CPR, then it has a good chance to go towards the CPR support level 1. So but what they are trading with the CPR, anything breaks the CPR R1, then it is a good chance to go for the target of CPR 2. Likewise, if anything breaks the CPR support level 1, then it has a good chance to go support level 2. This is support level 3, and this is support level 4. So up to 11,071. So that is what the range we are having, 11,087. Not much difference, around 10 to 20 points is the difference. We are having negative average 11,077, almost to CPR support level 1. So up to that particular level, the market having chances to fall. Anything breaks this CPR support level 1, then only it will go to the support level 2 CPR. If the points are too much high, means they are also telling that half of the mark it has a good chance to reach. So the points almost more than 100 points. So what it shows, that it will go to the average of 11,003 up to that level. So it is not going to be easy to understand on the day one. It has a good amount of time. So after the market closing, I will explain you much more clear way how to trade in this specific day. If anyone go for the bullish market, they have to keep stop loss in the range of previous closing stop loss 11,178. Wait, wait a minute, they are at 10 points. 11,168.40. This level they need to go for a stop loss. And anyone going for the sell, they must have to keep stop loss in the range of somewhere, if the pre-open is somewhere below the volatile level, then they can keep stop loss in the range of 11,264.